Hi, I'm Jenny Brown and welcome to this week's edition of MFB News. I hope you're really good. I hope you've had a fantastic week and all is absolutely peachy in your world. In terms of what we've got for you this week, we're going to do our usual roundup of what's been happening with swap rates and lender pricing. It's been an interesting week actually, so quite a lot to fill you in on in terms of what's been happening there. We're then going to move on to talking about house prices. Important for people who have buy-to-lets because we want to know the value of our assets, but also what we're noticing at Mortgages for Businesses, there is definitely a return of landlords looking to invest this year, having been largely dormant actually for the last 18 months. I think landlords have come into 2024, recognise that the kind of market is more favourable now, good, strong negotiation points on prices, rents are increasing and mortgage rates have come down. So very, very interesting for those of you who are looking to invest. And then finally, we're going to wrap up this week's episode with our question of the week. Okay, so swap rates are having a fairly tumultuous time at the moment, and this is largely owing to the uncertainty around the geopolitical situation, particularly sort of looking at the situation in the Red Sea. Obviously, if oil distribution is kind of cut down or made more expensive because of the routes that ships are having to take, that will impact the cost of oil, and that means that the cost of basically everything increases. So on the back of that kind of uncertainty that's going on there at the moment, the money markets are clearly feeling incredibly jittery in terms of how that could shake out and impact inflation. So where we are at the moment, so as of 11:30 on Tuesday evening, 2-year swap rates were at 4.219. Now, to give you a kind of measure of this, on the 2nd of January, they were at 4.037. And 1 year ago, so 1 month ago, 1 year ago, 3.997. So actually things are kind of down from where they have been, say, prior to Christmas, but they have eased back up in the last few weeks. Same story with 5-year swap rates. So as of last night, 5-year swaps were at 3.674. 1 month ago, 3.405, and 1 year ago, 3.556. Actually, I was checking swap rates yesterday during the day, and 5-year swaps were over 3.7. So things are moving around quite rapidly. And this leaves lenders in a very kind of difficult situation. What they like to see with swap rates is a fairly kind of consistent level of pricing, because if things are bouncing around, their cost of funds is fairly erratic, and it makes it very hard for them to price products. And so what they're faced with is a situation where they're kind of saying, well, okay, we know that swap rates are kind of, starting at this point and moving up to this point and bouncing around. So we're going to have to charge or work on the basis of the higher rate to ensure that actually when we're lending money out to people, our costs are covered, we're making margins. This is why we're seeing some kind of uncertainty in terms of lender pricing. So in terms of moving on from that and really how that's kind of shaken out, so there haven't been that many lenders repricing in the last week. I think a lot of them are just kind of sitting on their hands and just waiting for the dust to settle. However, we have seen Paragon withdraw all of their 5-year fixed rates on standard properties, and they did this last week, and they have yet to release some new products which are coming out Wednesday afternoon. Same story on their multi-unit and HMO rates. They were withdrawn at 5 o'clock on Tuesday evening, and new rates are going to be coming out on Wednesday. So Paragon have actually just pulled all of their 5-year fixes. Same story with Capital Home Loans. They pulled all of their Tier 1 products, and we're waiting for them to reprice. Those should be out in the next couple of days. And we've seen West One increase their rates by 0.35%. So rather than pull products and have nothing for a few days and wait for the dust to settle, what they've done is just increase their pricing. So that's kind of the more negative side, as it were, of the market. But actually, there have been a couple of lenders reducing rates as well. More notably, BM Solutions have reduced some of their fixed rates by up to 0.14% and introduced a sort of separate range of products with flat arrangement fees of £1,499. Additionally, TML, the mortgage lender, have made a reduction of 0.22% on one of their products. So a bit of a mixed bag, which I appreciate gives you a conflicting message about the direction of travel with interest rates. I think it's just worth keeping in mind that not all lenders are 100% exposed to the capital markets. So some lenders are lending off what we call balance sheets, so essentially savers money. So the kind of rate of return they have to pay, their cost of funds against that will be very different to when they're taking money from the capital markets. So different lenders have different funding models, which then impacts how quickly and how kind of rigorously they need to react to changes in swap rates. And that's why we're seeing a sort of mixed bag in terms of how lenders are reacting at the moment. Now, in terms of the kind of direction of travel for the future, it's very uncertain, if I'm honest with you. We're having lots of conversations with clients at the moment who are saying, I've heard interest rates are going to go down. I'm just going to sit on things for the time being. I'm going to leave it for a few weeks. The reality is at the moment we just don't entirely know how this is going to shake out. So it could be that actually the markets settle, the situation in the Red Sea particularly kind of calms, and actually we sort of return back to our downward trajectory. It could be that things escalate, in which case the cost of funds is going to start to increase again, because that will cause some real concern. So I think it is a case of largely at the moment no one's entirely sure how things are going to shake out. But I think the other thing, just to kind of remind you, and I know I sort of bang on about this week after week, is that most lenders, once you apply for a mortgage with them, if they reduce their rates before completion, they will let you move on to a lower interest rate. And I've done the same thing on one of my mortgages that I've got going through at the moment. The lender I'm using is Fleet Mortgages. We originally started on a certain interest rate. They've reduced their interest rates down, and I've been able to move my mortgage deal onto a lower price product. So what you can essentially do is hedge your position. So take a rate now, knowing that it's probably a worst case scenario. If rates go down before completion, move on to the lower rate. But likewise, if interest rates go up, you've still got that one secured. It's in the bag for you, as it were. So I hope that helps. I know it is quite difficult and quite disconcerting. We had hoped we'd seen the back of all of this uncertainty. But actually, we are where we are, and I think the next couple of weeks will be quite telling in terms of how things are going to go moving forwards. Okay, now Home Track have released their latest house price report, which always makes really interesting reading. So the executive summary tells us that UK house price inflation moderates to minus 0.8% on rising sale volumes. So essentially, annual house price inflation in the UK is currently sitting at minus 0.8%. Strong seasonal rebound in sales activity in the first weeks in January on the back of pent-up demand and sub 5% mortgage rates. So actually we are seeing coming into January, into the new year, a kind of strong kind of surge of people coming back to market, and they're tempted by slightly more favourable lending conditions. And really just to echo that point, demand is up 12% year on year, and this has been led strongly by London and the east of England. Sales agreed are up 13% year on year, so sales are up across all regions. That's really positive. Available homes for sale are over 20% higher than a year ago, so there are more properties for sale on the market now by 20% than there were 1 year ago. So we're actually reading that data, it kind of sounds like a very, very favourable market, and you could be forgiven for thinking that actually, we're kind of at the bottom and starting to work our way back up again. But what they did go on to say, it's important not to overinterpret the positive start to the year. There is some upside for sales volumes, but we remain in a buyer's market, and that 1/5 of sellers are having to accept more than 10% below the asking price to secure a tail, closer to 1 in 4 across southern England. So what this really tells us is that actually there is still very much a strong favour in terms of people who are looking to buy property at the moment, and there are deals to be done on properties. And I suspect this kind of echoing back to what I was saying earlier is why we're seeing a strong number of landlords looking to look to invest currently. Now, what they say in terms of the outlook, the adjustment to higher mortgage rates was always going to take longer than a year, especially given the modest fall in house prices over 2023. Lower mortgage rates are welcome news, but it seems unlikely rates will fall much further in the near term, remaining at between 4% and 5%, with the best deals for those with big deposits. This will support more sales rather than price rises in 2024, something business should welcome as volumes need to recover from the lows of 2023. So lower mortgage rates will mean that actually you'll have a greater ability to sell your property, but it doesn't mean you're going to be able to ask more money for it, in their opinion. Now, in terms of house prices, what I've got is a list here in front of me in terms of annual percentage house price change. And I won't go through the whole lot because there's like 18 of them. But I think in terms of house price changes, so interestingly, Belfast has actually increased by 4% over the last year. Glasgow increased 1.5%, Edinburgh 1.3%, Liverpool 0.9%, Leeds 0.6%. So there are actually still regions which are reporting positive increases in house prices year on year. Most badly hit, we've got Aberdeen at minus 2.9%, Southampton at minus 2.7%, Portsmouth at minus 2.3%, Cambridge minus 1.9%, Bournemouth minus 1.9%, and it sort of goes on from there. So it seems that actually in terms of the house pricing market, the prices are kind of very, very regionally impacted in terms of how or what value properties are selling for currently. So I think in terms of just kind of what we can deduct from this, what we can deduce is that actually the expectation still going forwards for this year is that we're not going to see continued drops in house prices. I think things are going to stay largely stagnant in terms of where house prices are. What we will see is there's more properties coming to the market. We're going to see more people looking to buy properties. So that will kind of help get the market moving, but that's really going to be all we're going to see in terms of change for the next 12 months, which therefore really kind of comes back to this point that in terms of landlords looking to invest, 2024 really does represent probably a very good year in terms of being able to secure a great price on an investment property. Question of the week. So one we get asked fairly often, and this is regards to how, or why maybe is probably a better way of positioning it. Lenders will apply what's called a block value to property, which is essentially a block of flats or a development of houses. So the question I got is, actually, I thought the property would be worth X amount of money. The value has gone out and reduced it by circa 30% because they've applied what's called a block value. What is this? So essentially, when a lender's looking to take on a multi-unit building or development, what they will do is say, well, okay, we're going to lend on this freehold property of self-contained units. If we had to repossess the property and sell it on, what we don't really want to have to be doing is creating individual leaseholds and then selling the properties off piecemeal. And the reason for that is really kind of twofold. So the first thing is that the lenders simply don't really want the aggravation of doing that, if we've been brutally honest. But the second thing is that actually, if you imagine there was a block of, say, 10 flats and all 10 flats came onto the market simultaneously, that would also then impact the amount of money these properties could sell for. So realistically, when you're looking at a block of flats, the lenders have to kind of assume that if they were going to sell it on, either they would have to create leases and take a reduced price because of the sheer volume of properties coming to the market at the same time, or they'd be selling it off as an investment, i.e. a block of flats, and therefore there would be a restricted demand in the market for that. So what this means is that actually when we're looking at financing a block of flats or a development of houses, lenders will often apply what's called a block value, which is essentially a reduced value compared to if you took the sum of the parts, that each flat is worth, say, £200,000, there's 10 of them, therefore it's worth 2 million. The kind of discount you're looking at on block values, it tends to be between 10 and 20%. Depending on the development, depending on the location, depending on the valuer even as well. But if you are building a block of flats or a development of houses and you're thinking about financing them, I think there's really kind of therefore two options for you to consider in this situation. So the first one would be simply accepting that the reality is that the value of the freehold is not the sum of all of the parts, so you're going to get a reduced valuation more than likely. And I would say this tends to apply for developments of probably more than 4 units. If the other option would be that you can sort of create separate leaseholds or titles for each individual unit and look to finance them individually, and we see the people doing this quite often. Now this can absolutely work. There does come with a few warning notices to sit alongside of that. So the first thing is, if you've got a larger development, particularly of say 10 units, one lender is unlikely to take on all 10 leaseholds because lenders will want to restrict their exposure in that development for the reasons we've already just discussed. So what we have to do is split out the units amongst numerous lenders. And what needs to happen is, broadly speaking, people are repaying some kind of development finance or existing mortgage. So the refinance of these individual units needs to happen all at the same time to raise enough money to clear that debt. So if you've got, say, 3 different lenders or 4 different lenders at play and you're running all these different applications, it can actually become quite tricky to get all of the applications to offer and complete at exactly the same time. So it can be kind of quite troublesome in that regard. So something that we have done before numerous times on very successful basis, but just to know that it's not straightforward. But there are options out there. So if you are doing a development of flats or have a development of flats or a little development of houses or even a large development of houses, and you're wondering how they're going to get valued by the surveyor, that's what a block value actually is. And I hope that helps in terms of ways that you can kind of manage your expectations or look to capitalise on the valuations when you come to getting a mortgage. And there you go, another week. And I think this is the end of January, isn't it? So I will see you guys in February. This year's already going by so quickly. If you have any questions, as always, give us a call, 0345 345 6788. And as I mentioned last week, our new website is looking rather special and has loads of information if you want to go and have a look there as well. Have a fantastic week. Have a really super and incredibly peaceful weekend. And I'll see you again same time next week.